Welcome back. You're with us here on a special edition of Market Masters. We're speaking with the top team at ICICI Prudential AMC. Okay, let's just drill it down to sectors and what you like as themes. Anish, one of the big bets for you has been real estate and housing, right? Have you seen, and we've asked company after company on the program, on the channel over the last many weeks, has demand taken a bit of a knock as wealth effect has taken a hit because of markets falling? What is your own sense? Because, you know, that really has connections with so many other areas and it's so important for the economy as such. Has real estate and housing demand taken a bit of a hit, or does that remain in good state?
So it has softened a little bit, that there's no doubt. So what needs to be seen, right, is that if demand has weakened, the prices in the real estate market should be corrected, or there should be price flexibility downwards so that demand recovers. Actually, if we are sitting here 1 year later, right, or 2 years later, and the economy has not delivered, then the most likely cause of that would be that real estate prices remained stuck at a level where there were no volume of activity, or the volume of activity was subpar. Right? I can't see the economy doing well without good housing activity. At the same time, I can't see the economy doing poorly if housing activity is strong. Even this cycle, right, 3 years back, when you see it picked up only when housing activity started recovering, right? So if there is price flexibility downwards, developers, cut prices to ensure that sales continue happening, and they keep constructing, that would be good enough. The only point I'd make is, I'm not placing a bet. That doesn't mean you should invest in the housing sector or in real estate companies. The point is that that is a driver for economic activity across the board. And you can play the cycle in other sectors also, because if housing recovers, other sectors will also do well as a result of the sort of spillover effect. So overall, I'm positive on domestic cyclicals, which includes automobiles, cement, financials selectively, and industrial and capital goods. What we are cautious on is FMCG, and we have been for a while, and IT.
And on financials, Anish, you said select financials. Can you elaborate on that point? Because it's a very wide basket, from capital marketplace to insurance, where there's so many deals happening, to obviously the big banks. What is your order of preference there?
So within the lending space, right, I'm going only for deposit-rich financials. I'm still worried about unsecured consumer credit. So I'm avoiding names where there is a lot of exposure to unsecured consumer credit, particularly if the exposure has grown very fast recently, right? So I would like strong deposit franchises, and other financials, I mean, we like basically, particularly insurance, we have an overweight on. See, basically what I'm saying is, if the economic activity recovers, right, both savings and investment pool increases, and there is a greater role for financial intermediation. So financials will do well, provided you avoid areas where there are clear credit risks, or if they are too reliant on, exuberance of capital markets, right? So overall financials should do well. You should avoid areas where there is too much reliance on capital market activity or credit risks.
Manish, we're also rounding up the financial year, and it's been one of those curious years where the Nifty return is about 7.5%. I mean, it almost is looking like fixed income type of returns. Gold has returned 40%. So the question is asset allocation, and looking forward to the next year, FY26, which asset class do you think could steal the thunder? And, also a brief outlook on fixed income itself. And what's the right mix that you would recommend?
Right. So at ICICI Prudential, we always believed in asset allocation, and the reason is that every asset class has a phase where it does very well. And why I say a phase is because there's a lot of behavioral element which get into an asset class. So for example, gold, I mean, we gave a positive call on gold in 22 and 23, and the reason for that was that, one, it has underperformed against a lot of asset classes at that point of time. And secondly, given that uncertainty globally had increased, we thought that gold was a good hedge against, the financial assets. Now, gold has performed, as you said rightly, it has given, outsized returns against other asset classes. Do we see gold as the same hedge as it was 2 years back? I think the answer is no. you need to see the valuation when you look at each of the asset classes. And we believe in mean reversion. So while gold has done exceedingly well in the last 2 years, its ability to give a hedge on the portfolio has reduced meaningfully. I think fixed income looks pretty attractive at this point of time. And the reason we are saying that is, one, we are at a point where, we're seeing a mid-cycle correction. And, we also in the last 3-4 months had a problem of outflows. Now, those outflows also led to tightness of liquidity in, generally the banking system. That led to increase in spreads in the short end of the curve. When I look at, the 1 to 3 year part of the corporate bond market, I see a lot of value over there where, once, some of the liquidity which RBI has provided comes back into the banking system, as we go into the next financial year, the government spends that money. We'll again see that liquidity is easy, RBI is cutting interest rates, and people will then again go back to, protect their reinvestment. And therefore, I think in the very near term, fixed income returns look pretty attractive.
Okay, well, clear view and, bonds clearly more attractive. Appreciate your time, gentlemen, here on this special edition of Market Masters. Anish, Manish and Anand, thank you for being with us here. We'll, of course, get an update on these views as we go along and, of course, figure out where the market is headed as well. So interesting next many weeks and months coming up with lots of events lined up. Thank you very much once again. We'll take a quick commercial break here. Programming continues on the other side.